Welcome back to The Explainer, everyone. Today we're taking on an absolute giant of the financial world. We're going to break down MetLife's incredibly successful first quarter 2026 earnings report. Now, if you've ever tried to read through a 100-page SEC filing or one of those super dense financial supplements, you know it can honestly feel like you're trying to translate a lost ancient language, right? But don't worry, that is exactly why we're here. We're going to extract the pure signal from all that noise and make sense of exactly what is driving this massive global insurer without getting bogged down in endless spreadsheets. Let's get into it.
Okay, so we're going to deconstruct this report in 5 clear, rapid-fire chapters. First, the headline numbers. Second, the key drivers of growth. Third, global segment performance. Fourth, their strategic moves in capital. And finally, number 5, the market reaction.
All right, kicking things off with Section 1, Q1 2026 headline numbers. And let me tell you, it was a massive surge. 30%. Seriously, when a mature, established company like MetLife reports earnings, you generally expect, steady, incremental changes. But this quarter, a 30% surge in net income compared to the exact same period last year. For a company of this sheer scale, generating a 30% bottom-line jump in a single year is a phenomenal feat, and it really sets an aggressive, upbeat tempo for this entire report.
And just to put that in perspective, look at the absolute numbers here. We're talking about a leap from $879 million in the first quarter of 2025 up to a staggering $1.14 billion in Q1 2026. Translating that percentage into hard, billion-dollar figures really highlights the sheer magnitude of this quarter's success.
And just to ground this in reality, we can look right at the raw data from their corporate overview table, which verifies that $1.14 billion net income figure for the quarter ended March 31, 2026. So this isn't just some clever financial spin, this is the raw, GAAP-reported data proving out that headline strength.
Which brings us to Section 2, key drivers of growth. Because the natural question is, how do they actually do it?
Well, notice the stark visual contrast between these growth metrics. The first one shows total revenue edging up just a modest 1.3%. But then, move over to the right, net investment income climbed a very healthy 10%. And then, look at that third one. Variable investment income absolutely skyrocketed by 58%, hitting $518 million.
So, what's the secret sauce behind that crazy 58% spike? The earnings release actually calls out higher private equity returns as the main engine pushing that variable investment income so high. You combine those private equity wins with favorable life underwriting margins and solid volume growth across their platforms, and you've basically got the perfect recipe for bottom-line expansion even when the top-line revenue is relatively flat. Seeing a company's bottom line expand this aggressively without needing a massive revenue jump, that is a huge indicator of serious margin strength.
Moving right along to Section 3, global segment performance. Let's take a rapid-fire tour around the world.
Now, sometimes a great quarter is just a fluke in one single department, right? But these numbers show a really resounding, broad-based victory. Adjusted earnings were up across every single geographic and business segment they have. Group benefits climbed 19%, retirement and income solutions were up 11%, Asia surged by 31%, Latin America grew 5%, and the EMEA region, Europe, Middle East, and Africa, jumped a massive 33%.
The big takeaway here is that specific, calculated strategic moves paid off brilliantly. Take that 31% jump in Asia. That was driven heavily by really strong sales in Japan and Korea. And we absolutely cannot ignore MetLife Investment Management, or MIM. Their adjusted earnings surged 68%, and total assets under management jumped 22%. That was the direct result of them successfully integrating their Pine Bridge Investments acquisition.
Okay, Section 4. Strategic moves and capital. This is all about building that financial foundation.
It's one thing for a company to generate a ton of cash. It's a completely different thing to actually return it to the owners. $1.1 billion. That is the amount of capital MetLife handed directly back to its shareholders through share repurchases and common stock dividends in just one single quarter. That is a massive commitment to shareholder yield. And when a company buys back its own stock at this scale, it's actively increasing the remaining shareholders' claim on all future earnings.
But what's cool is that beneath all that flashy capital return, they're still maintaining incredibly disciplined execution. They finished out the quarter with $3.9 billion in holding company cash, which puts them right at the very top of their target range. Their adjusted book value per share also rose 4% to $57.41. And crucially, they secured an adjusted return on equity of 17%.
That ROE metric is vital. It proves that management is highly efficient at compounding owner capital. Basically, they're playing heavy offense with buybacks, but keeping a fortress-like defense with their cash reserves.
Finally, let's jump to Section 5, Market Reaction and Strength. This is where expectations meet reality.
So how did Wall Street actually digest this tidal wave of positive data? Well, looking at the numbers from Indexbox and Bar Chart, reality heavily beat expectations. MetLife reported an adjusted earnings per share of $2.44, which beat analyst estimates by 6.6%, and the market definitely rewarded them for it. Over the past 52 weeks, the stock is up 21.6%. That completely outperforms the broader S&P 500, which is up 18.4%, and it absolutely crushes the broader financial sector ETF, XLF, which is only up a relatively measly 7.1%.
Now, to be totally fair and impartial, it wasn't a completely flawless sweep. The one minor hiccup in the quarter was total revenue. While total sales did hit $19.07 billion, which is a 1.3% year-over-year increase, it actually missed the super high revenue forecast set by analysts. I think it just goes to show you how demanding the market can be, even when a company is generating literally record profits.
But honestly, any concerns you might have about that slight revenue miss are pretty much instantly quieted when you look at their underlying financial strength. Metropolitan Life Insurance Company holds pristine, bedrock stability ratings across the board. We're talking an A+ from AM Best, an AA from Fitch, an AA3 from Moody's, and an AA- from Standard & Poor's. This acts as a massive economic moat for them. Their foundation is just rock solid, basically ensuring they can meet their obligations no matter what kind of curveballs the macroeconomy throws at them. Which leaves us with this final, provocative thought. MetLife CEO noted that they're currently in year 2 of their New Frontier strategy, meaning they're heavily modernizing through AI and digital investments to boost productivity. You couple that tech modernization with the massive long-term demographic tailwinds of aging populations driving up demand for retirement and income products, and the stage is totally set. So the big question now is, will MetLife's incredible momentum from this quarter seamlessly compound into the next? Well, we are certainly going to be watching those next earnings releases very closely to find out. Thank you so much for joining me on this explainer today, and keep learning.